Okay, this report was released by Fannie Mae, which is the biggest, most important thing in real estate that no one is talking about right now. I do not know why, but we're going to go through this report and I'm going to tell you exactly what it means. So I'm Stephen Clark. I flipped over 100 homes and sold over 200. So I'm going to give you my unique perspective on this. Unique is always such a hard word for me. All right, let's look right here. So this was a report as of last month, but it's still really relevant because we're going to get another report from them in the next couple days. So we're gonna be able to juxtapose what this one says because there's some really interesting trends that are still affecting the housing market today, obviously, because it wasn't that long ago. And we're gonna be able to juxtapose it to the new one to get a even better, more definite ideal of what is going on in the market. The first page, I almost highlighted everything, right? It says the 2022 real gross domestic product, so the GDP, is going to be flat at 0% growth on Q4 and the Q4 basis. And the latest GDP showed an expected decline in Q2, but a recent data points to modest growth in Q3. So basically they're saying we're gonna end the year at 0% growth. And they said a couple factors because of that. The tightening monetary policy, where Jerome Powell is raising interest rates, we know that. So the US monetary policy is causing a lot of this, along with fading fiscal stimulus and suppressed consumer spending. And they also quoted one more thing, which I thought was really, really interesting. And I have not seen many people in real estate media kind of talk about it. And we're going to hit that today too. Before we get any further, like and subscribe to this channel. Y'all are loving it. So the big news here is they expect a moderate contraction to occur in 2023 along with a weakening of the labor market. Our forecast for 2023 GDP basis is negative 0.4%, unchanged from the prior forecast. So this is saying that this year, 2022, is going to end in zero growth. And that's because it lost a lot of the momentum over the last two quarters, right? Q3 and Q4 made zero growth. But going into 2023, they expect this to be a negative 0.5% growth, which is a recession. So they're expecting and they're calling and forecasting a recession. Now that's going to be huge, whether we're buying or selling. And there's a lot of key telling points about how people are buying and how people are selling right now that we're going to get to as well. But the major thing here is that recessionary prediction. And it's likely to be, I believe, revised for an even worse recession when this next forecast comes out. A lot of things have happened since this report, but the basics are there, and the basics have already showed that they're thinking that this is going to go down on half a point percentage for GDP contraction, overall contraction. So that's because June measure came in stronger than they expected at 1.3% month over month, while July reading was weaker than anticipated at 0% growth over month. So global disruptions to manufacturing could reverse much of the progress seen in July. Now, we have not talked much about the global economy here, but the global economy is coming into play because the global economy is also contracting as well. So you have the U.S. economy contracting and actually bringing everything else down, and you have the global economy contracting as well. And you've seen that in the euro, you've seen that in other popular currencies. The one thing that's actually doing really, really well is Japan right now. So, and they're also October 11th, they're open to tourists again. Tourists, not the astrological sign, but the actual people. I'm actually both. So anyway, CPI on an annual basis to average 7.2% in Q4 2022, which is slow down from 8.5% on an annual basis measured in July, with the core measure averaging 5.9%. Important. So the CPI is your consumer price index, and it measures inflation. So they're saying that the inflation numbers that they've gotten in August, and I'm guessing in September, when September numbers come out, are going to be lower than expected too. Now, when the Fed just met, they were expecting it to be 8.3. Oh, excuse me, they were expecting it to be 8.1, but it came in at 8.3. So it came in much hotter than anticipated. So then the stock market fell down because the stock market said, oh, snap, they're going to raise interest rates again. And they did. So this information is saying right now that there are less CPI pressures than there were back then. So they think that CPI data is actually going to be lower this time around too, which might be good for us because it might mean that they're going to pump the brakes on raising interest rates, or maybe pump the brakes on how fast they do it, because they can do up to 100 basis points. They might just do 25 next time. They might do 50. You never know. It might be smaller than they did last time, which was 75 percentage basis points. So we know the economy is completely being stagnant right now, and a good metric for that is looking at the overall job market, right? So a good metric for if the housing market is going to be strong or not is unemployment strong. So if your unemployment is good and there's low unemployment, then your housing market's going to be strong. So this is why we look at the unemployment numbers, and there's some interesting trends in this unemployment number, and they actually said something I've never seen them say before. So 528,000 payroll jobs added in July, and 461,000 on average added monthly over the first half of the year. So it says, similar to GDP and GDI, one possibility is that some of this measured labor market strength may eventually be revised away, shrinking the divergence. So they're actually saying right here, I think they made a measurement error. The people that are taking these numbers, I think they made a measurement error, and they said once it does go back and get revised again, maybe this measurement error will go away and it won't be as good of a labor market. Everyone is kind of scratching their heads right now. They're like, how is the labor market so good and so thriving, but the house market has really slowed down and even lost lots of its gains, and maybe even reverse and being in a decline in lots of different markets, depending on where you look. And their explanation was, I think they made a measuring mistake. So I thought that was really, really interesting. And when they do get those revised numbers, which should be in this next September report, then we'll be able to see if it's true. Did they actually make a measuring mistake, or is the job market still really great, but the housing market is not good? Because that would throw a lot of cold water on their indicators. My prediction here is that maybe it was a measurement error, but that the job market is not as good as I think it is, and it is probably going to get worse as well as we get deeper into this recession. Of course, I think that's a huge, crazy prediction, but even though the labor force is doing well with unemployment, their productivity has fallen. Now, this is not something I'm an expert in, is how the productivity numbers affect the overall housing market and what levers they affect in macroeconomics, but it is still really interesting to touch because they gave 3 factors about why they think this is happening. 2.6%, the largest annual decline on record. We do not know with certainty what is driving this development, but we hypothesize that there's at least 3 factors. The economy is adjusting to post-COVID norms, and it's leading to a significant amount of physical capital becoming partially obsolete and less productive. 2, the elevated worker job switching rate in recent quarters is temporarily suppressing labor productivity. And 3, high and volatile inflation is disrupting price signals in the economy that guide labor, capital, and other business resource allocation decisions, leading to greater inefficiencies. And rising inflation in the 1970s also coincided with periods of negative productivity growth. And you can see right here, this is our graph. Move my fat head out of the way. So annual decline in labor productivity is the highest on record ever. So that is a wild number, and we're going to see the effects of that as well. They added another graph for our viewing pleasure. So the 2-year, 10-year spread inversion widens, while the 3-month, 10-year spread is almost flat. So this is a really huge indicator for the likelihood of a recession or not. So with modest economic growth to resume in the near term, but the effects of tightening monetary policy and rolling off fiscal policy, as well as slowdowns in growth abroad, have not yet been fully felt by the U.S. economy, coinciding with a modest recession. The curve is more severely inverted over the past month. Now, I think this Treasury yield curve is going to invert even more with the September numbers, and probably to the rest of the year, honestly, and maybe even into Q1, Q2 of 2023. And that would just give us the likelihood of a recession, and then once we hit it, the likelihood of the depth of the recession, how deep it will be, or not. Headline inflation was flat over the month, while the annual rate fell from 9.1% in June to 8.5% in July. And they say a lot of it is because of the oil price volatility here. So you can see oil price volatility remains through global growth concerns are weighing on prices. So at least that is a little kind of beacon of hope right here. They also expect a weakening in the demand of goods in the coming month, which should lead to lower price pressure. Since we do have inflation, and since the economy is contracting, they're thinking people will buy less and they'll kind of lock in what they already have, and then that will bring down the pressures on the manufacturing, right? Because manufacturing is still having some problems around the world due to COVID still, due to the slowing economy. Manufacturing having some problems, but they said it might be kind of balanced out once people get more poor because the economy is going down, which I think is probably exactly what's going to happen as well. So that's going to really be into how they are looking at things for the future. I think this is one of the most interesting things. Chairman Jerome Powell at the last Federal Open Market Committee meeting stated that the Fed will be relying less heavily on policy guidance moving forward, which means he's been getting his policy guidance from the president, from the White House, and from the people in charge right now, and would now be more data dependent moving forward. You see right there, data dependent. And so they have another report and CPI reading between now and September, of course, which we've already gotten, but they're going to have another one in next month as well. And they said the recent pullback is not really helping affordability. So we can look at this chart right here, and it's really, really interesting because you would think the recent mortgage pullback would allow more people to afford homes because the prices would go down. But that's not what you're seeing. You're seeing the prices stay really high, even though affordability, even though what people can buy is less and affordability has not changed. So recent pullback only modestly helps with affordability. So it assumes 20% down payment, average 0.30 year fixed mortgage rate. But you see, it's not even close to where it was in the affordability of 2008 or 2018 at all. So we can see affordability has just been out of control, and that's really, really huge when you look at, are we going to buy more houses in the future, or are we not? Because right now it shows that the percentage of the median household income to buy a home is still at historic highs. The June existing home sales, so June, July, were a little stronger than they anticipated, but they still put their reading down 16% from July 2021 as far as pending sales and home sales outlook for 2022. So they think they're revising it down 16%, which is huge. Builder sentiment continues to fall along new home sales as housing market cools. So new home builds is what they look at a lot to kind of gauge the housing market and gauge if people are still buying, because it's very easy to say, okay, people are buying, and it's a future number. So new home builds are really interesting because it tells you, once again, what people are buying, and if they're anticipatory on what the market is doing, right? So if you buy a new home, you're buying lots, that's what they say in this article, and you have to wait 3 to 6 months for everything to be finished, up and running, to be built, etc. That being said, if people are not buying lots, that means that they think it's going to be cheaper in 3 to 6 months than it is now, and or they don't want to be locked in to the mortgage rates because they think they might go down. So this is a sign of an unsure buyer, the ones that don't buy new homes according to them. So monthly supply for homes is starting to risen sharply over the past few months. As you can see, we're starting to get more inventory, which is actually going to be pretty good, right? There's still a supply issue, there's still an affordability issue. So if we get more inventory, that's going to really, really boost up the affordability of the market, and that's going to allow more people to buy homes. That's going to allow prices to potentially fall from sellers. Right now they're talking about having a locked-in buyer, the locked-in housing market, which means that people that have homes are staying, and people are not buying homes, so you're just kind of locking in. But that takes a couple months to maturate. It takes a couple months for the Federal Reserve monetary policies to really sink into the rest of the economy, which is why people are kind of so that Jerome Powell is raising inflation so fast, because we're like, whoa, chill. You've done it 3 consecutive times in a row. Chill out. Let it maturate. Let it simmer. You don't want to rush this thing. It's a marathon, not a sprint, buddy. Chill the F out. So that's where people are having problems. And I completely agree. I don't think that we have really fully felt the effects of the monetary policy, of the global slowdown and contraction, and of the manufacturing, and of the inflation numbers that are actually potentially decreasing after raising the interest rate. So I think they would give it a second, but it looks like 2023 going into a recession. I think it's going to be a deeper, worse recession than this chart and these graphs and these numbers predicted, or what their official forecast was. I think it's going to be even worse. But my little house flipper take on it is there is a time to buy all the time, right? And it's deal by deal basis. So if a deal is good, there can be a good deal in any market. You can always find a way to buy an asset, and I'm all about buying assets. And if you're on this channel, you're probably wondering about buying or selling one yourself. So my non-financial advice prediction would be, if you're looking to sell, probably should have done that yesterday. That's what I'm doing. I'm exiting all my positions. If you're looking to buy, my hypothesis would be at least 3 to 6 months, you'll see lower prices and a lot more inventory. So you have a lot more chances to find something you like, even if it is an Airbnb, even if it is a multifamily, even if it is a more investment focused thing. I think the longer we get into this recession, the more options and choices you're going to have. Of course, you will be paying more for that first year. Mortgage rates are up significantly, but I do expect them to fall back down. So you can flirt with the rate, but you marry the price. If you get a good price and lock it in for 30 years, that's gonna be great. And you can always refinance out of that high interest rate. Like and subscribe to this channel for more. We have more updates coming at you. Thanks for, I don't know, I need to find a good sign off, like peace. Kisses seems weird, because it's a housing channel. Maybe like deuces. That seems about right. Okay, deuces.